Hello, everybody. Thank you for registering for this webinar. The topic of today's webinar is corporate tax in the United Arab Emirates. The webinar will be also posted on YouTube. You can click the link in the description and download a PDF of this presentation after leaving your details. My name is Sergey Gorchakov. I'm a chartered accountant. I have more than 20 years experience in finance and tax on the corporate side in companies in different jurisdictions, including Russia, Europe, USA, South America, African countries, and UAE, of course. I'm CEO of Consorata. We provide accounting and tax services. We form companies and assist with residents in Dubai. Please get in touch for more details. Okay, corporate tax. The government declared the vision and key policy framework, as you can see in this slide. You can read all the items later when you get the PDF of the presentation. Let's start from the tax rate. It is 9% and it is lower compared with Saudi Arabia, for example, where they have 20%. On top of that, we still don't pay any payroll tax or any kind of withholding taxes from salaries and wages. And social security contributions are minimal if we consider payments to the small payments to the unemployment scheme. Timeline. We all heard that corporate tax became applicable from 1st June 2023. But what does it mean in reality? Well, it all depends on the financial year of your company, which can be found in the constitutional documents such as MOA, Memorandum of Association, or it could be some other documents which could differ from free zone to free zone. Okay, let's consider this first case. So in this case, your first taxable period will be from June till May, June 23 till May 24. And you will have extra 9 months to file your first tax return. So the final deadline is 28 February 2025. And you can register for the corporate tax purposes before filing your tax return. But of course, we strongly recommend you to register as soon as possible because the list of the documents is short and it's much more simple than register for the VAT purposes, for example. Well, for most companies in the UAE, you will have financial year from January to December. It means that your financial year will be the same as calendar year, and your first taxable period will be from January till December 2024. And corporate tax becomes applicable from 1st January 2024. And you will have the same thing, extra 9 months before 30th September 2025 to file your first tax return. But once again, we encourage you to register as soon as possible because it's just a registration and you will fulfill your obligations here and yeah, nothing else. And you will still have time to file, to prepare, of course, your all your documents and to file your tax return before the deadline. Okay, taxable persons. All the domestic legal entities have to be registered for the corporate tax purposes. We will come back to the free zone companies on the next slide, but let's take a look at all the entities which are subject to corporate tax registration. So besides all domestic companies, limited partnerships have to be registered as well, and some foreign entities have to be registered. For example, those having permanent establishment in the UAE or entities having a POEM, which is the place of effective management, and some other foreign unincorporated, in other words, with no legally not registered legally, let's say, but some partnerships. If we speak about natural persons, of course, when we speak about salaries and wages, income from personal investment and real estate investment income, you don't have to be registered for the corporate tax purposes. But in cases when you have a commercial license to do any business or commercial activity, you have to be registered for the corporate tax purposes. But the good news is, in case if your revenue doesn't exceed 1 million dirhams per year, and it's applicable to the current year when the corporate tax becomes applicable for you and for all previous years. So when your revenue doesn't exceed 1 million dirhams, you won't be paying any tax. Also, when you own establishment or proprietorships, or you are a partner of the fiscally transparent entities, you have to be registered for the corporate tax purposes. Exempt persons, okay, it's all clear here for the government legal entities and for companies wholly owned by the government. Besides, if we speak about entities engaged in extraction of natural resources, of course they're exempt too because they already pay oil extraction or natural resources extraction tax. And also charities and public benefit organizations, they're exempt. Besides, investment funds are exempt too. Why? Because the government wants to bring more investment funds and management companies to the UAE. And we also have a small business relief in case if your revenue is less than 3 million dirhams per year, and it's applicable to all the current and previous periods. So in such a case, you are exempt till 31st December 2026. But once again, it's applicable only if your revenue has never exceeded 3 million dirhams per year in current or any prior period. So you have to consider that. Okay, speaking about the taxable base, of course, for the residents, which are listed here, once again, we consider them, the taxable base is their worldwide income, with some few exceptions. And the residents are listed. Non-residents are those which are not residents. So it's also quite transparent definition here. And for the non-residents, only income attributable to the permanent establishment and income sourced in the UAE will be subject to the corporate tax. What is income sourced in the UAE? You can read the slide, of course, but it's applicable once again to the non-residents. Okay, free zone entities. We've created a decision tree to understand what should you do here. Okay, let's say in simple case, you don't want to be a qualifying free zone person and you will become just a regular taxable person under the regular corporate tax regime. And so you will be paying tax of 9% with the exemption, of course, if your taxable profit is less than equal to 375,000 dirhams, you will be paying 0%, and above that, if your taxable profit is above that, you will be paying 9%. What do you need to be a qualifying free zone person? You need to maintain a substance in there, of course. You need to have qualifying income. You shouldn't be in the regular corporate tax regime. You have, for example, when you have related parties you trade with, for example, in the country or outside the country, you have to have the proper transfer pricing. Not just you shouldn't be just compliant with transfer pricing, but it should be also documented. But we will come to that a little bit later. And you have to file your audited financials. So in such a case, you can be the qualifying free zone person. But once again, sometimes you should consider all the costs here. And let's say if your costs are higher than the tax you could be potentially paying under the normal scheme, under the regular corporate tax regime. Of course, maybe it's not worth to maintain this qualifying zone free zone person status. At the same time, keep in mind, for example, if you're a normal taxable person, the regular corporate tax regime, you might be exempt from the corporate tax in case if your revenue is below 3 million dirhams. So please consider that too. Okay, if you're a qualifying free zone person, please also consider that for example, when you have non-qualifying and excluded activity, so it shouldn't exceed 5% of your total revenue, and at the same time, this revenue shouldn't be more than 5 million dirhams. And in case if your de minimis threshold is exceeded, you might lose your qualifying free zone person status for 5 years. So be careful here. And there could be some other cases. Okay, let's take a look at the qualifying activities. Of course, when you produce something, you shouldn't be trading with the mainland entities and natural persons directly. So you should distribute only via a reseller. So this should be only the qualifying activities. And whatever is non-qualifying, of course, it will go into the revenue from those activities will go into the different bucket, and it shouldn't exceed, like I said, 5% or 5 million dirhams per year. Okay, we also have exempt income. It's dividends, other income, profit of branches under certain conditions, of course, and something else if it's applicable to you. What about dividends? Well, it's let's say maybe it's traditional participation exemption here. So of course, when you get dividends from free zone companies and mainland companies, they're exempt. But if you get the same from the companies outside the UAE, so you have to have these participation exemption conditions. So you should have minimum 5% shareholding, excuse me, or 4 million dirhams, and this foreign subsidiary or the investee, we can call it like that, it should be subject to corporate tax or maybe income tax or equivalent of 9% minimum. And your intended ownership or actual ownership should be more than 12 months. So in such a case, the dividends are exempt. The same is applicable to capital gain when you sell shares in these companies, so absolutely the same. And for example, when you get profits from foreign subsidy, foreign branches, you basically will have two options. The first option is to pay tax in each of the countries, of course, if such an election is allowed, because most probably in most Western countries, so to say, you will be paying taxes on the profits in those countries. But if you have such an election and you elected to pay this tax, so it could be deducted as credit in the UAE. And there is also the second option. Please take a look here. But once again, once you have selected your option, your selection is irrevocable. Participation exemption, once again, a little bit more details about that. So yeah, and when you define your applicable expenses, which could be capitalized, those are disallowed expenditures: professional fees, litigation costs, stamp duty, valuation, so on. Permanent establishment. These are detailed conditions of the permanent establishment. But once again, if somebody needs more details on that or some consultation, please get in touch. We can discuss that. Place of effective management. So once again, what are the conditions? Oh, they are pretty standard, I guess. And of course, if your legal entity is managed from the UAE, which is defined by these key indicators, you have to consider that carefully. And you have also secondary factors here. There is also a new interesting thing, tax group regime. So when is it applicable, first of all? Well, when you have probably a legal group, in other words, when your parent company owns at least 95% in subsidiaries, and there are also some certain additional conditions. So what could be done here? First of all, you might have single tax return for the entire group. So you will have consolidated tax position and somewhat reduced tax compliance costs, right? At the same time, you won't need to, your cash flow won't suffer because you won't be paying tax and you won't be claiming it back. Why? Because it's single tax return, right? Also, you don't need to prepare any transfer pricing here. So it is supposed to be that you're already compliant with that. Also flexible enter-exit provisions. But once again, it's already maybe more complicated cases. If it's not applicable to you, just it's better to consider your special situations. Okay. Another case, for example, if you are a physical person and you have two companies with 75% in each at minimum. So in such a case, and all the other conditions are similar. So in such a case, if your first company suffered some losses, they can be offset against income and against taxable income in another company. Also, another interesting case when you have a qualified group where you, as a physical natural person, or your holding company has 75% minimum in two companies, so, and all the conditions are listed here. You might have a relief. You can transfer assets or liabilities between the same qualifying group, and there will be no any taxable income or loss. Okay, it also could be interesting cases for some persons. What are the corporate tax rates? Well, as you might have heard, they were even declared like the first and the second tax rate, and there is supposed to be the third tax rate. And uh, what is this all about? Okay, in the simple case, when your profit is up to your taxable profit is up to 375,000, the tax rate is 0%, and we will consider a simple case later on. With the profits over 375,000, you will pay 9% tax rate. And in case if your revenue is above 750 million euros, which is equivalent of around 3 billion dirhams per year, you should have a higher tax rate. It was declared in 2022, but to date, this threshold is not defined yet. So it means that technically we have two thresholds right now, or well, let's say one threshold right now and two tax rates. So whatever your profit is in the first tax year, until we have some news, it will be 9%. So keep that in mind. In order to calculate your taxable income, you have to take your accounting income and you have to adjust it. And there are some options for unrealized gains and losses. And there is, of course, exempt income, which we have just considered. But yeah, once again, let's take a look at the details. Of course, one might say, but look, I heard that some guys told me, yes, I should take my taxable revenue and I should deduct only taxable expenses. Of course, it's maybe another simple approach, but it could be applicable only when you have a very small company. Let's say when you have just one employee, you don't have anybody. But in most cases, and as it is defined in the law, you should take your accounting net profit and you should go from there. You have to do your adjustments and you have to get the taxable income. So it's all up to you how to calculate it, but in the end, you should get the same result. Okay, the same definition for the participation exemption we just considered, and there are a little bit more details in here. So you will have other expense adjustments. So what should be considered here? First of all, when you have uh, some expenses incurred in connection with raising of finance, they could be added to the interest capping. But in any case, your interest expenditure could be deducted up to 30% of EBITDA. Of course, what is EBITDA? It's another definition. It's not an IFRS measure, but in any case, uh, it's predefined. And the good news here is when you have loans maybe in first years, but you repaid your loans and you don't have any interest expense in further years, so this non-deductible interest expense can be carried forward and utilized in subsequent 10 years. Of course, it's not applicable to banks and other financial institutions. Why? Because when they have primary income from interest, and the same is applicable to their interest expense, of course, they are deductible in full. the interest expenditures are deductible in full. And also, there are specific cases for related parties. For example, when you get a loan and your related party pays full 9% interest, 9% corporate tax on its interest income, it means that you can deduct it in full when you pay interest expense. There could be also some other adjustments. Of course, first of all, there should be an arm's length principle. For what does it mean? For example, if you are the owner of the company and you pay yourself $50,000 salary every month, of course, it's not market. Well, it could be the market rate, so to say, but of course, you should consider that carefully. But let's say your market rate for the CEO of your company would be $10,000 or respective amount in dirhams. So it means that you have to add $40,000 to the taxable income. Why? Because you pay something above the market rate, right? And regarding the tax loss relief, you can offset up to 75% of your taxable income against your prior losses, and it's not limited, so it's unlimited for the you can keep your tax loss carry forward for the unlimited period. There are also certain rules for the current foreign tax credits. In any case, your FTC should be kept at the level of tax amount paid in foreign jurisdiction, and it shouldn't be higher than the corporate tax you would be paying on the foreign sourced income. So, in other words, if you paid it at a higher rate, let's say 24% somewhere in the UK, in any case, you can offset your foreign tax credit at 9% maximum of the income of the taxable income under consideration. Be careful here. And if there is any withholding tax, well, it's currently under 0%. So in other words, you don't have any withholding tax in the UAE. But in any case, you could offset it in future when the tax rate probably is different. Let's take a look at the computation of taxable income. Uh, Of course, if you're a qualifying free zone person, it's quite simple there. On your qualifying income, you pay 0%, and on your non-qualifying income, you pay 9%. It's pretty simple. And if we speak about normal case, let's consider, because although it's predefined, but let's say when you have your taxable income of 5 million dirhams, what you should be paying. Of course, if it's below taxable threshold, you will pay nothing. And you pay 9% of the income above the first threshold. And your effective tax rate in that case will be 8.325%. How do we compute the taxable income? So what do we take? We take the profit before tax. Of course, it's supposed to be net profit in the earlier years, but because we have the income tax right now, it will become the profit before tax. And we take it and we add all disallowed expenses, which we've just discussed. It's interest expense about 30% EBITDA, all other expenses. For example, there's threshold for the entertainment expenses. So whatever is above 50% is not deductible. Same is applicable to the annual salary above the arm's length basis. And if there are any disallowed expenses in future, they have to be added back here. And at the same time, you have to deduct all exempt income, whatever is here, and probably some other adjustments. And then you get your taxable income, which is here, and it should go here, and you just compute your taxable income. And once again, it's the same thing. So you just get your tax liability, you deduct if you can your any foreign tax credit, and you get your tax liability and you pay it. Quite simple. Withholding tax. Once again, if it's applicable to you, we can discuss this later during the Q&A session, or just get in touch. We can discuss that. So for right now, given that the withholding tax is set at 0%, it is not expected there will be any requirements to register or file for the withholding tax purposes. But anyways, what has been defined that withholding tax credit could be reduce the corporate tax payable. Tax compliance. And one of the very first questions which I am asked, you know, isn't the corporate tax the same as VAT? And the guys might be saying, look, I already registered for the VAT purposes, and why do I have to be registered for the corporate tax purposes? Well, first of all, not everybody is subject to the VAT. Why? Because they're below certain thresholds, they don't have a big enough revenue, or it could be just, some companies working with exempt revenue, something like that. So yeah, VAT is different, and VAT is a consumption tax, but corporate tax is essentially an income tax, and it means that before this regime just didn't exist in the UAE, and now uh, it's applicable to all the companies. So it's different things. So although you might be registered for the VAT, and in some cases you might not be registered, most probably you will have more cases when you are subject to the corporate tax regime. So once again, be careful here. It's good to know penalties. So basically we've listed the main penalties, let's say here, or let's put it in a different way. You have to keep your accounting records, and of course you also have to be ready to provide your documents related to tax, and you have to provide them sometimes in Arabic. So uh, you have to keep that in mind. You have to submit the registration application in case if you are not subject to corporate tax anymore. Of course, in cases when you ceased your activities, for example, and you want to liquidate your company. So be careful of that. You have to submit your tax return on time. You have to submit it without mistakes, right? And in case when you found some errors, you have to file a voluntary disclosure. So be careful with that, and you have to pay your tax on time, of course. And once again, what we also missed here, we didn't put some more penalties in case you might have a tax audit, and for example, when you just got an official notification that you will have a tax audit, and for example you filed your voluntary disclosure. So in such a case these penalties will go up significantly. What does it mean? So I think they want to avoid situations when you got a notification about the tax audit and you filed voluntary disclosure that you had presumably some errors in prior periods. So they want to avoid that, and in such case you will be paying much higher penalties. Okay, there could be some penalties related to the tax audit. Of course, not to the tax audit itself, but in case you have some situations during the tax audit. So please just be careful, be responsive, be cooperative when you have the tax audit. And there are also some tax aspects. After you have registered, you will obtain a tax registration number. You will have 9 months after the end of your taxable period, and after you have filed your tax return, you will get the tax assessment. If you don't like something about the tax assessment, you can challenge it in the court. Related parties and transfer pricing. First of all, we have a definition of related parties. It's in here, and I think that it's pretty clear. It's pretty close to the definition on the FRS. We just await the significant influence clarification. It's not defined just yet. but most probably it will be similar with what we have in the IFRS. Transfer pricing, it has been just clarified in the October decision, so it should be arm's length principle so for cross-border and domestic arrangement between related parties, including the free zone persons. And basically, there are five methods, and the transfer pricing policy here is broadly in line with with that one declared by OECD transfer pricing guidelines. So in such a case, when you, for example, already work with other countries and you might have this transfer pricing policy, I guess it won't take much time to adapt your transfer pricing policy, so it should be applicable to the UAE too. But in case if it's something new to you, you might get in touch and we might help with that. But yeah, once again, it's listed here. It's a new one. Like I said, it has been just approved in October 2023. Well, some other first year aspects you need to keep in mind. Of course, there could be some qualified audit opinions. It's not clear how to deal with them. It could be some other, let's say, because many companies didn't do any audit, and what happens with the unaudited open balances and some other aspects. So just keep that in mind. Also, there is an important Article 50, General Anti-Abuse Rule. So this is the applicability and implications, and be very careful with that. So why? Because there are different factors and key takeaways. But what we found out of this article, provisions of GAR are applicable immediately. So if they find something suspicious, uh, it means that it will become immediately applicable to your company. And there is no threshold to apply provisions. So let's assume even if you have 100 dirhams somewhere here, right? So it could be become applicable. And the implications are really severe. So please try to avoid it by any means. Also, there has been a recent ministerial decision 114. Basically, there are three main items in it. First of all, cash accounting is allowed, so it means you might not be using accrual accounting, which is normal for IFRS purposes. But if your revenue is below 3 million dirhams per year, you can apply cash account. So, in other words, when you might do tax accounting on the cash basis. So let's say when your expenses are expenses only when they are paid, and your income is income when you just receive the money to your bank account. SME for IFRS for SMEs is applied if revenue doesn't exceed 50 million dirhams, and mandatory application of full IFRS if revenue exceeds 50 million. What is also the conclusion? Of course, when you you prepare your financial statements for the year prior to the first tax period, you have to recognize deferred tax assets and liabilities in the prior year, and you have already applied arm's length principle for related parties transactions. And also increase disclosure in the financial year and the financial statements for the first financial year. It's listed here. Okay, what's next? Well, from my side, I think that some clarification is needed. I've listed all my concerns, and I can comment on that. And why I've listed this here? Because look, first we've got the corporate tax law, and we've got some clarifications throughout the last year. And I think we should have some more clarifications in future before we have the first tax return and even further, because some of these issues are not clear for me right now. And that's first of all the higher tax rate. I think we should get it because it was already announced, but we just don't have the rate yet. What about the offshore companies? I mean, the companies which are registered in the UAE under the offshore, so to say, jurisdiction. I've seen only two companies like that, and I think it's maybe not an issue right now. I don't think there are a lot of new companies like that because it's practically impossible to open a bank account for those companies, at least in the UAE. But, anyways, in case these companies still exist, so what happens to them? Are they subject to the corporate tax? Should it be, for example, if you get dividends or capital gain from those companies, from selling shares in those companies, what happens there? So it's not 100% transparent. Uh, Also, we need more information. I think that right now it's quite difficult to read through all the documents because they're in different places. But yeah, I think it will be clarified a little bit better at a later stage. And also, what about passive income when we are subject to regular corporate tax regime and we get some rental income and capital gain from investments? So it's not clearly said. Now it appears that it should be fully taxable, but let's see what happens later on. For example, free zone persons, well, first of all, for free zone qualifying activities, I think we need more clarification because the list is not really big right now. It's around it's around 9 to 10 items. But yeah, I think it should be detailed later on because in reality, you might have some more qualifying activities. Although there is a list like on all additional activities like related to those listed, but yeah, I think it will be detailed later on. Same as applicable to the audit of financial statements. One thing that there should be clarification. Now it sounds like you have to have the audit of your financial statements. But because in this ministerial decision we have clarification that SMEs might, IFRS for SMEs might be applied if your revenue doesn't exceed something and you might have cash accounting for tax purposes. So maybe there could be some exemption here too. And I think the list of exempt persons should be clarified with some details. And of course, some other clarification which could be applicable to your business, to your special situations. Let's see. Thank you very much for participating in the webinar. I hope it was useful and informative. If you watch it on YouTube and you liked my webinar, please click thumbs up. Subscribe to the channel and put some comments down below. All our details are on this slide, and if you need to find out more information, then reach out for a consultation. Thank you all again for your attention and see you soon. Have a good one. Okay, and now let's move to the Q&A. Okay.